When you hear Trump's big, beautiful bill, expect bold, controversial moves that could reshape markets. Get ready for what this means for investors. In 2025, this bill is causing waves in financial markets and making a mortgage ETF the talk of the Wall Street. This isn't just another campaign slogan. This bill has incentives and tax advantages, transforming money flows into key sectors. Today, we'll explore how this bill has supercharged a specific dividend ETF, making it a potential goldmine for investors. Trump continues to champion business with this bill, focusing on energy, infrastructure, manufacturing, and defense. The bill provides corporate tax incentives, dividend-friendly loopholes, and spending favoring Trump's allies. The stock market reacts by directing capital accordingly. Dividend ETFs are usually overlooked, but can shine when yields are high and payouts are frequent, especially amid inflation and low bond returns. With Trump's bill, sectors under regulatory strain got relief. Energy companies saw immediate benefits in areas like oil and gas infrastructure. Defense contractors began anticipating government budget expansions, hinting at possible financial breakthroughs in their field. Manufacturers promised reshoring benefits and optimism grew. As dividends looked more secure, ETFs tracking these stocks began to shine. The ETF became the biggest beneficiary almost overnight, as volume spiked with institutional investors rotating in. Analysts called it undervalued with policy tailwinds, and soon retail investors noticed a fund exceeding 3 to 4% yields, approaching double digits. In a political environment rewarding dividend payers, government spending and regulatory rollbacks enhance profitability for these companies. Ultimately, a basket of stocks neatly packaged into an ETF can be bought with a single click, opening investment opportunities. For long-term investors, it's a hidden doorway into steady cash flow. Traders see an opportunity to ride the momentum. For retirees, it's high, consistent payouts with potential capital appreciation on top. Critics might point to real risks. What if the bill faces challenges in the courts or political shifts occur? Markets don't focus on future uncertainties. They react to what's happening now. The incentives are real and cash is flowing. The ETF is climbing in price and reputation, similar to the hype around meme stocks in 2021, but rooted in real policy. He sells economic concepts with larger-than-life bravado. This resonates with his base and signals victory to investors. When presidential rhetoric aligns with tax code incentives, money managers take notice. They're driven by one thing: returns. ETFs are benefiting more than individual stocks due to their diversification. They manage risks while capitalizing on sector booms. Picking a single company exposes you to specific risks. An ETF provides a smoother ride while still enabling gains. Smart investors prefer sector or dividend ETFs for the policy advantages without putting all their eggs in one basket. Dividend investing was once seen as slow and conservative, but it still holds psychological appeal for many investors. Younger investors often preferred growth stocks, but as inflation squeezed wallets, dividends became appealing again, offering monthly or quarterly income. With influencers and financial YouTubers hyping this ETF, the narrative is irresistible, creating increased demand and pushing prices higher. Despite the hype, every goldmine has its dust. Corrections and pullbacks are inevitable. Investors need to gauge if the fundamentals justify this excitement. This time, The fundamentals are stronger. The signed policy has real tax implications, and companies are adjusting their strategies accordingly. Analysts believe this ETF is not just a passing fad, but a serious opportunity due to structural changes within the market. Imagine 5 years from now when these companies have reinvested tax savings, expanded operations, and increased payouts. Investors who bought in early are collecting fat dividends and enjoying capital gains from share price appreciation. While nothing in investing is guaranteed, today's foundation makes this dream more realistic than most. The question for everyday investors is whether to jump in now or wait for a dip. Timing is tricky. Positioning early in policy-driven money flows can lead to greater potential rewards. Small positions can diversify portfolios. Trump's policy, often seen as chaotic, has created stability for dividend investors. In a time when global markets feel uncertain, there's something comforting about a steady check from an ETF boosted by government incentives. Love him or hate him, Trump's bill has changed the game in 2025, and it might just change your portfolio too. Trump's big, beautiful bill just turned this dividend ETF into a goldmine. They're not exaggerating. This rare alignment of politics, policy, and profit doesn't come around often. It could be a once-in-a-decade opportunity. Nearly 30% of the holdings are tied to energy infrastructure, pipelines, refining companies, and oil field services firms. Under previous administrations, environmental restrictions and carbon taxes acted like a brake on their growth. But with Trump's bill easing restrictions, companies looked 10 years younger. Analysts who once wrote them off are now revising price targets upward, and dividend forecasts are being recalibrated higher. This optimism feeds directly into the ETF, which scoops up those payouts and passes them along to investors. Defense and aerospace comprise another 20% of the ETF. Trump allocated billions to modernization and new shipbuilding programs for a strong military. Contractors like Lockheed and Raytheon enjoy guaranteed revenue for the next decade, raising dividends consistently due to long-term contracts. Manufacturing is the third pillar. Firms that bring operations back to U.S. soil are reaping benefits like reshoring incentives and tax credits for domestic production. Think steel, construction materials, industrial machinery. These often overlooked companies form the backbone of dividend strategies. The ETF benefits from dividends collected from more competitive companies with lighter tax burdens. The financial sector also thrives with corporate activity. Banks and insurers benefit from expanding interest rate margins. Analysts are calling this ETF a goldmine, engineered to ride the wave of Trump's policy with high yields. However, history reminds us of pitfalls. Reagan's tax cuts led to a corporate boom, but corrections followed in the 90s. Investors who blindly chased yields without watching fundamentals got burned. The same risk applies here. If Trump's bill balloons deficits too aggressively, bond markets may revolt and interest rates may spike. Smart investors don't just jump on hype. They monitor debt-to-equity ratios, payout ratios, and cash flow sustainability. This moment feels unique due to a convergence of populism, nationalism, and pro-business rhetoric. Millennials and Gen Z don't want to make the same mistakes as their parents, highlighting a shift in investment perspectives. Trump's bill injected adrenaline into a sleepy market sector, reminding us that policy reshapes balance sheets and rewires cash flows. By tracking changes early, you can position yourself for benefits. This is seen now with the Dividend ETF. a product of the new money trail. For some, it's about holding the ETF for income. For others, it's trading to capture momentum as hype builds. Sophisticated investors may use the ETF as a hedge due to its stability in energy and defense. The beauty of an ETF is its flexibility. You don't need to be a billionaire to access a structurally altered ecosystem. Ultimately, this story is less about politics and more about the investment opportunities available to savvy investors. Opportunities don't wait. They come wrapped in uncertainty, noise, and controversy, just like this bill. While others argue, investors who see the potential are already collecting dividends and building positions for the next decade. So, what are you going to do? Watch from the sidelines or study the fundamentals and carve out your place? Donald Trump just reshaped a corner of the market in 2025. This ETF will be remembered as a winner from that shift. The Goldmine is here. Will you dig in? This moment reshapes the psychology of investing. For years, dividends were seen as something from the past, safe, predictable incomes. But in 2025, that perception is changing. With Trump's bill and dividend-focused ETFs on the rise, dividends are becoming a hot topic in finance. Investors who once chased fast-paced opportunities now ask, what dividend ETF should I buy? This shift highlights a generational change in wealth building, valuing steady, compounding cash flow over speculative investments. Institutional money is now crucial. Hedge funds and pension funds seek predictable returns, investing billions. When they notice a promising dividend ETF, they act swiftly, altering the fund's trajectory with their buying power. We've observed volume spikes and big-name managers increasing positions, revealing confidence in dividend strategies. When institutions set their sights on something, it creates multi-year tailwinds, not just retail hype. The US market still stands as the most secure and liquid globally, attracting foreign investors from Asia and Europe. Dollar-denominated assets generating yield are increasingly attractive amidst low international bond yields. This influx of global capital adds demand, driving share prices and liquidity higher, validating domestic plays. In 2025, investment strategies are not only discussed on CNBC or Bloomberg, but also on TikTok and YouTube. When a dividend ETF starts generating headlines because of policy-driven boosts, it doesn't stay a niche secret for long. Influencers brand it as a must-watch, and retail investors start downloading trading apps and setting up recurring buys. 10 years ago, this ETF might have taken months or years to gain traction. Today, it can happen in days. Skeptics will argue that we've seen this movie before. Political tailwinds create short-term euphoria, and valuations get stretched. What differentiates this ETF is its foundation built on signed legislation, not speculation or promises. While pullbacks are inevitable, the overarching trend could still be upward for years if structural benefits persist. An often overlooked piece of this story is the cultural element of Trump's brand. Whether you love him or hate him, Trump is a marketing machine. He doesn't just pass policies, he packages them in a way that captures attention. Big, beautiful bill isn't just rhetoric, it's branding. When a president uses bold language to describe legislation and then delivers tangible economic shifts, it creates a sense of momentum that financial markets feed on. People don't just want returns, they want to feel like they're part of something historic. This dividend ETF taps into that narrative perfectly. Dividends are essentially a distribution of a company's profits back to shareholders. When tax incentives reduce corporate obligations, companies have more free cash flow. Many of the companies inside this ETF are in mature industries, energy, defense, manufacturing, where growth opportunities are slower, but cash flow is strong. These companies are far more likely to increase dividends than pursue moonshot R&D. That predictability is what investors crave. When bundled in one ETF, the combined effect is a steady, rising stream of income that looks bulletproof compared to growth plays. Investors often underestimate the power of reinvested dividends. Imagine buying into this ETF today, yielding 8 to 10% annually. If you reinvest those dividends over 5 years, your effective returns compound significantly, accelerating wealth. Smart investors know the importance of risk management. One risk is concentration that could drag the entire fund down. Due diligence is critical. Look at the fund's expense ratio, historical performance, sector allocation, and management team. Don't just buy the story, study the structure. The good news is that even with risks, the reward profile remains attractive, especially if you're allocating a portion of a diversified portfolio. If you found this breakdown useful, don't forget to hit that like button, share it with a friend, and subscribe. Drop your thoughts in the comments. I'd love to hear your take. See you in the next one.